Hey everyone there, it's David Barnett once again. I wanted to make a little video here today about deferred revenue, or what can sometimes be called a liability hidden in plain sight. And the reason I'm making this video is because I had a conversation with a business broker recently who was telling me about a deal of his that had broken down and was looking for my advice in how to prevent this from happening again. But first, before we can get into the story, let me explain to you the concept of deferred revenue. It's basically how do we treat sales for which we're paid today, but we have to deliver service over a period of time. So I've got a simple balance sheet here created, and as you know, assets always equal liabilities and equity when you're talking about a balance sheet. Let's consider, for example, a simple service business. Let's say house painting. So I'm going to paint a room in your house and I'm going to charge you $120. And of course the cost of the paint, that's on a separate statement. That's on the income statement where our income and expenses are listed. This is the balance sheet. So let's say that I charge you $120. So now my cash goes up by $120 because I've accepted this money from you. And let's say that I owe the paint store $60. So now I've got an account payable of $60, and I made a profit of $60 on the paint job. So my owner's equity goes to 60. So you see, they balance. So 60 and 60 is 120. My cash has gone up, my owner's equity has gone up, and by taking the paint from the paint store but not paying them yet for $60 worth of paint, my accounts payable has gone up as well. So they balance. Now let's, for instance, take the example of a fitness center. So a fitness center typically sells memberships, and they might sell an annual membership, let's say, for 12 months. And let's say for the purpose of ease, that it's going to be $120 for an annual membership. So how do we represent that on the balance sheet? Let's say if you were to buy an annual membership for $120 on January the 1st. Well, our cash would still go up by $120, but what would happen on that day, because we still haven't delivered a year's worth of fitness services, is we would have what we call deferred revenue or deferred income of 120. Now, this can be called deferred revenue, deferred income. It depends on your industry, where you are in the world, etc. But the idea is this is a liability for a service that we have yet to deliver to our customer. Now, let's fast forward 1 month. What happens when we go from January the 1st to February the 1st? We've delivered 1 month of that service, so our deferred revenue or deferred income goes down by $10, and our owner's equity can go up by $10. The cash didn't change because we accepted that cash on January the 1st. So as time goes on, this deferred income or deferred revenue obligation, the liability associated with delivering the service, will go down as we deliver the service. The problem is, most small businesses don't involve this level of sophistication in their bookkeeping. So if you were to look at the books of most small fitness centers, they would simply record on January 1st a sale of $120. They wouldn't go through the process of recognizing the liability associated with having to deliver service to that customer over the course of the year. Now, back to my story. In this particular case, it was a business that sold equipment that came with 1 year of warranty protection provided by the seller, the dealer. So in the balance sheet that was presented as part of the package of information given to buyers, there was a balance sheet there showing the current status of the company, but there was no deferred income or deferred revenue liability there. In the documentation, it said that all sales were given a 12-month warranty. So the buyers looked at the income of the business, They looked at the normalized income that the business broker was presenting. They used that as the basis for evaluating what they thought the business was worth. They negotiated back and forth with the seller, and they arrived at a price. Once they had that deal in hand, they then went to due diligence, which is the normal process. Their accountant started to investigate the numbers and said, hey, wait a second. Do you guys realize that if you buy this business and you take over the clientele, you're going to have to spend money paying technicians to go and do warranty work for these customers that paid the seller, and you're not getting part of that revenue. They then went back to the seller and said, look, we need you to be responsible for the warranties that you issued for the sales that you made. And they tried several different things. They said, let's calculate what we feel this liability is worth, and we can adjust the price of the business. They said, why don't we simply bill you back against the vendor take-back note at $25 an hour for the work our technicians have to do to go service those warranties for which you were paid for. They tried several different things. And do you know what the seller came back and said every time? No, I'm not going to compensate you for those warranties because the warranties were disclosed to you up front. You should have taken it into account when you made your offer. So basically, we have two people that now get entrenched in their positions, and neither one is willing to budge because both feel that they have sort of the moral high ground, or that both think that they are right. The seller says he disclosed it up front. The buyer says, I didn't realize that there was this cost associated with it at the time. The business broker was asking me, how can I get out of this jam? And I said, look, the only real way to get the buyer and seller to move again is for one of them to move. So either the buyer has to agree to swallow the cost he wasn't thinking that he was going to have to incur, or the seller is going to have to, agree to a lower price, or is going to have to agree to compensate the buyer for warranty work done to the clients that bought before the transaction. How could the broker have avoided this problem? Easy. In the normalization of the financial statements, which is typically done before a business is presented to a buyer, business brokers and sellers are usually focused on removing non-necessary expenses. Like if a business happens to pay for the owner's daughter's cell phone, they're quick to add back that expense and say, look, this isn't a real business expense, because they're looking for ways to enhance the value of the company. They want to show the biggest possible income. But where business brokers sometimes fail is that they don't look at the other side of the coin. They don't say, what additional expenses is a buyer going to have to undertake because they're in a different situation from the seller. Maybe the seller owns personally owned tools or equipment that are used in the business. Now, those tools and equipment aren't included in the sale, so a buyer has to either buy them or go rent them, for example, and that's going to impact the income of the business. I said to the broker, what you need to do is you need to normalize that balance sheet, and you need to disclose on the balance sheet that there is a liability associated with the sales that have already been made. Even if you have to calculate that figure on your own based on how many warranties are outstanding and just, saying that on average they require 5 hours of labor to maintain the warranties and using $25 an hour, here's the figure. In the case of the story I'm telling you about, that kind of calculation added up to about $30,000. So it was significant. It was about 10% of the purchase price of the business. Anyway, I just wanted to share with you one of these hazards that can potentially happen in businesses that actually get prepaid for things that they do, because it's not something we're not always looking for. Usually businesses sell products and services and then have to wait to get paid. But there are certain businesses that are in this prepayment sort of category, which is great for their cash flow. But as a business buyer, you need to make sure that you understand what liabilities potentially you're agreeing to take on when you buy the business. We'll talk with you later. And don't forget, if you enjoy the video, please like it and share it amongst your own social networks. That's how I grow my audience. And don't forget to sign up for my email list. People on the email list get to see things before other people, and they also get access to all of my great deals, offers, etc. Thanks a lot, and we'll talk to you soon. Hey, you made it to the end of the video. That's great. Don't forget, visit www.investlocalbook.com. Sign up for my email list. It's right down here under the welcome video. Thanks, and we'll see you next time.